Hey guys, welcome to Module 2. Before I begin, I would like to thank each and every one of you to watch it till here. Really appreciate it. Technical analysis works on one principle. History repeats itself. What do I mean by this? Imagine you see dark clouds out there and you are like, it's going to rain. But how do you know it's going to rain? Because in the past, when there were dark clouds out there, it rained. Not once, not twice, but multiple times. Similarly, when you see certain types of patterns in our chart or indicators indicating something, or there are theories, it means the price would go up or go down because it happened in the past. Not once, not twice, but multiple times. With this, we'll jump into the very basics of technical analysis. Technical analysis is done usually in three methods: charts, indicators, and theories. Charts can be of many types. There can be candlestick charts, there can be line charts, there can be bar charts, there can be Renko charts, there can be volume charts, there can be range bar charts, and the list goes on and on and on. But we are interested in candlestick charts. Talking about candlestick charts, we try to find patterns in these charts. Patterns can be of a few candles or many candles. So this is a chart of TCS. When you Google TCS stock price or something, a line chart would come which would look similar to this. A candlestick chart of the same TCS share would look like this. If you look closely, you can see red and green bars. Each of these bars represents a candle. Talking about candles, candles can be of two types: green candles or the bullish candle, or the red candle, or also known as the bearish candle. The terms bullish and bearish comes with the attacking style of these animals. So a bull has horns, so when it attacks, you tend to go up, whereas a bear swipes down. You can imagine the journey of a candle as a war between the bulls and the bears. Imagine one end filled with bulls and the other end filled with bears. The bulls are the buyers and the bears are the sellers. When they collide or when they fight, if the bulls win the fight, it's a green candle or bullish candle. If the bear wins the fight, it's a red candle or a bearish candle. Irrespective of the color, if you see here, this is called the body of the candle. This is called the upper wick or the upper shadow of the candle. This is called the lower wick or the lower shadow of the candle. And by this, I do not mean there is a white color candle out there. This is a representation of the candles irrespective of the colors. Every candle has OCHL or 4 points called as open, close, high price, low price. Now, if I consider a green candle, this would be the open price. This would be this point, as in the lowest point of the lower shadow would be the low price. This point, that is the highest point of the body, green body, is called the close price or the closing price. This part of the upper shadow, topmost part of the upper shadow, is called the high price. So you can imagine a scenario where the price opened here, then the bears tried fighting really hard. They brought the price till this point, but the bulls were very strong. They fought back and they took the price up till the highest point. But then the bears tried fighting back again, and finally price closed here and the bulls at the end of the day won. Similarly, if you consider a red candle, the price opened here, the open price. This is the highest price. The high and the low remains the same. This is the open price and this is the close price. And in this, the bears won. That is why there is a red candle. Coming back to the TCS chart which we saw, now this would make more sense to you. Each candle, this is a daily chart, and each candle represents a day. So on this day, the bears won. But if you see, the bulls really tried hard. The previous day also, the bulls really tried hard. But at the end of the day, the bears won. This is the daily chart where each candle represents a single day. There can be different time frames too. If you consider an hourly chart, it would look like this. So if that was one day consists of around 6 trading hours, that is from 9:15 to 3:30. So you can take 6 candles, that forms one candle over there. in the daily chart. So this is an hourly chart. Similarly, there are many time frames out there, time frame charts out there. They can be 1 minute, 2 minute, 3 minute, 4 minute, 5 minute, 10 minutes, 15 minutes, 30 minutes, hourly, 2 hours, 3 hours, a day, a week, a month. And how do you exactly decide which chart to pick? It depends on your trading style, whatever you prefer. So if you're planning to trade intraday, that is if you buy on some day and you plan to sell it on the same day, you can look at 5 minute chart, 15 minute chart, 30 minute chart, or even hourly chart. I would recommend you not to use 1, 2, 3, 4, 5 or even 10 minutes chart, because it is a very small time frame to get a meaningful candle. So you should wait for a bit, probably 15 minutes. But if you are a swing trader, by swing trading I mean you buy it on some day and wait for say a week, a couple of weeks till your target is achieved. You can use the hourly chart, the daily chart, or even the weekly chart. For long, as in long traders, as in people who are willing to hold it for a year or so, a year or maybe 2 years, maybe they can use the daily chart, weekly chart, or even the monthly chart. This totally depends on your trading style. When you start trading, you will find your comfort zone. The bigger the time frame, the bigger profits you can earn, but that also require a lot of patience. At the end of the day, it's your style, your choice. With this, we will end this video. Thank you for watching, and I'll see you in the next video. Cheers.